Today I wanted to talk to you about student loans because I, like many thousands of other people, now have interest accruing on my student loans. And yes, it is going to be painful. But I use a spreadsheet to monitor my loans. One, for peace of mind, so I know and I can see the progress that I'm making on my loans. But also, I can make sure that my information matches what my loan provider is giving me. So let's talk about loans. We'll talk about how interest is accrued on your loan and how your payments are being applied to your loan. So you can use this for future planning, for early payoff, budgeting. Maybe you want to make multiple payments in a month. It's entirely up to you, but this will show you where your dollars are going. Okay, so for this example, I've made a couple of assumptions. The information here at the top, date of disbursement, is just loan information. You can plug in these numbers for yourself. Total disbursement is, the total of the loan amount, the original loan amount that you were given. Date when you entered repayment, again, just information for you to keep up with. Your loan number, that'll come from your provider. Mine are with Nelnet, so we have group numbers like Group AA, Group AB. Your provider may have a different loan number structure. That's fine, just plug it in. Interest rate is the interest rate that's on your loan. It is needed for the calculations, so we will actually convert that. So in the calculation, it will, in this case, your interest rate is 6.53. So in the calculation, your interest rate is actually 0.0653. It will give you a daily accrued interest amount because remember, this is interest that is accruing on your daily balance. So it's not like a simple interest loan where you know all of the interest costs ahead of time and then you're reducing that over time. This is an accrued interest, so it's calculated daily based on your balance. And I can show you how you can confirm what this daily accrued interest amount is. And then the other things we've assumed for this loan is that there's a capitalized interest amount. So capitalized interest is any accrued interest that you have not paid. And what happens is that amount gets capitalized or added to the total balance of the loan. So in this case, we're going to assume $550 is added to the original principal amount, your original loan amount. So now your total is $10,550. And that is what your daily interest amount is being determined on. Okay. So August 1, 2025, we now have interest accruing on our student loans. And it's painful. It's painful for me too, but this is our reality. So for your payment in August, what you need to determine is the date you're going to make the payment. So click in here, say you're going to make the payment on the 25th. Then this spreadsheet will automatically calculate the number of days in the payment cycle that is needed to determine your daily interest amount. Okay, very important. So in this spreadsheet, the formula is already calculated for you. Your payment amount is how much you can make in that, how much money you can pay on the loan for this cycle. So we're going to keep nice round numbers and just say that you're going to pay $100. Okay. This interest amount is the total balance, so the $10,550, times the rate. So the interest rate is 6.53, but in the formula it's 0.0653. That's divided by 365, which is the total number of days in the year. If you're using this calculation for a leap year, remember to change that to 366 days. And then that decision, that calculation is multiplied by the total number of days in the payment cycle. So remember, this total number of days in the payment cycle will change depending on what day of the month you make a payment. And it may change based on what time of day you make that payment. So I think Nelnet has their cutoff at 4 p.m. Eastern. So if you make a payment after 4 p.m. Eastern, then you're going to have an additional day of accrued interest calculated against that loan. So if you're trying to do an early payoff, or you're trying to just pay the whole loan off, make sure you do it before that cutoff time. Otherwise, you will have another day of accrued interest applied to the loan. And it's been my experience that they will not take it off. Okay. All right. So for this assumption, for month one, you're going to make the payment on August 25th. There's 24 days in that cycle, which is just the difference between these two dates. Your payment amount is $100. Well, how is that payment amount applied? So in this example, there's $550 of capitalized interest on this loan. So what your loan provider is going to do is, out of this payment amount, they will first subtract the current cycle's interest amount. Whatever's left will go against capitalized interest, which is painful. I get it. And what you see is, for the principal amount, you've made absolutely no headway on getting rid of that principal amount. Yes, you're paying down the total of the loan, but it's all going to interest. So essentially what's happening is, if you have capitalized interest and you're getting an interest charge on the month, you're paying interest on interest. That's what hurts for student loans. It's because if your payment isn't enough to cover all of that, you will not make any headway on getting these loans paid off. So, action number one for any of you that have capitalized interest on your student loans, pay it off. Don't worry about principal, pay off that capitalized interest. Then you will begin to see a big difference in where your payment is going. Okay? So let's factor this down a few months and see what happens. So we're going to assume that this was the August payment, so payment of $100. It paid the $45 of interest for the month, and then the rest of it reduced the capitalized interest. Now, if you want to confirm what your daily interest rate is, you can do that in this spreadsheet. Just change the date to August 2nd, so it's only a 1 day. And you can see here that it's $1.89 per day. That's what's being calculated based on this total balance here. Okay. Now let's change this back to what your payment date was, August 25th. Okay, so now you've paid August, you put it away, don't think about it. Now it's September and you're ready to make another payment. Just come to the spreadsheet, put in the date in September that you're making the payment. This calculates the number of days. So you'll see that the total interest accrued went up because your payment cycle is longer. The accrued cycle is longer. Okay, so your interest is more. And if we assume the same $100 payment, again, this $100 payment is going to pay off this $58 in interest first, and then the rest of it is going to reduce the capitalized interest. Still, no headway is made on the principal balance. All right, so let's take this down a few more months. Let's go to October, and let's go to November. And let's fill into December. Okay. And let's assume $100 payment. Oops. If I can type this correctly. $100 payment. And you have to make sure that you fill these in correctly, otherwise it's going to mess up the formula. Okay. Now, let's assume you've made regular monthly payments of $100 through to December. Your number of days in the pay cycles calculating correctly. It goes to 31 and 30 because, we have some months with 30 days and some with 31. And you get to this point of capitalized interest where it's down to $322. And say it's the end of the year, you've gotten a bonus, you've worked extra hours, whatever, and you want to make an impact on your loan, and you've decided you want to pay off that capitalized interest. You can do it, but you have to make a payment that is equal to this capitalized interest amount plus what's being calculated for the current month. Okay. So let's say we're going to make this payment in January of 2026, same day. And you want to make a payment for January that is equal to this amount plus the current month of interest. Okay. So your payment is going to equal capitalized interest plus the current month of interest. Enter. That's how you get this capitalized interest to 0. Okay? So that's where your calculations change a little bit. So now, let's go to February. I'm going to just assume the same day of the month. I'm going to go ahead and fill these all in to March. April. And May. June. And July. Okay, make sure we got that right. So August, September, October, November, December, January, February, March, April, May, June, July. Okay. So days in the payment cycle, again, the formula already exists in the spreadsheet, so it determines that for you. So in January, you made the decision to pay off the capitalized interest and the current month interest. So now your capitalized interest amount is 0. And you'll notice that the principal balance column and now the total balance column equal. This is the point where you can start making a difference in that principal balance. Okay? Because let's assume a $100 payment still. Now this principal amount is going to equal your principal payment minus what was charged in interest. This needs to be 0 all the way down. You can just enter 0 if you want. Okay. Make sure that these numbers that are supposed to be 0 aren't showing a negative because that will skew your calculations a little bit. Okay. So now for February, you've made a $100 payment. It's calculated $55 in interest. You have $44 of that going to principal. So now your principal balance, so your new principal balance is going to be G10 minus E11. So now, if you figure in, let's just assume that you're making $100 payments for the rest of the year, or through July anyway. So this gives you 1 year of payments. You see the interest amount is calculating. You see you now have a principal amount for each month. Capitalized interest is 0 because you don't owe any more of that. You've paid it all off. And now, come end of July, you've now reduced your principal balance. And the total balance is going to stay the same because this total balance column is just capitalized interest plus your principal balance. Well, at this point, they equal. So they will equal all the way down. Okay? That is how your payments are determined, how your interest is determined, and that's how your payment is applied to your loan. So now that you've paid off the capitalized interest, again, that is rule number 1. No matter how much it is, that is your focus. Get it paid off. Now you're at a point where you want to make even more headway on these loans and get them paid off, then increase the amount that you're paying every month. So let's just assume that in May, you're able now to pay $150 a month. And you watch this loan balance, it's going to start going down faster. Okay? So that's how it works. I have all of my loans through Nelnet set up like this. I monitor it every few days. I've been monitoring it every few days, waiting for these decisions to be made. And every time I make a payment, I update my spreadsheet based on the payment that I've made. I give it a couple of days to apply at Nelnet because it takes like 48 hours. And then I go back in and check it and make sure, again, that what I have matches what they have. The only thing I've noticed is with interest calculation for my loan for this first day, I noticed a couple had like a penny rounding difference. Like my spreadsheet calculated 1 penny more than what Nelnet was calculating. It just depends on how Nelnet is, like how many decimals, how many places past the decimal point are they using to determine rounding. So just monitor it and see, if it gets way out of whack, then go to Nelnet and ask how they're, or your provider, and ask how they're calculating that interest amount. But if it's just a penny or so, once you've made the payment, and especially if it's in your favor, just adjust your spreadsheet. So say, for example, this calculation determined it was $45.30, but let's assume Nelnet only charged, or your provider only charged $45.29. Well, once you make the payment, you can just come in here and type in the true amount for your records. But in general, out of all of my loans, I think only 2 of them had a penny difference. So it's really not a lot. Again, just monitor it. If it gets way out of whack, then contact your provider. And that's student loans. Years ago when I was not able to make any payments on my student loans, I was having capitalized interest charged and it was hurting. I knew it was going to hurt, but there was a point in my life when I wasn't financially able to do anything about it. But now I'm at a point where I can pay loans and hopefully make a difference and not have them into retirement, which I think is everybody's goal. But I hope this helps. It shows you how the interest is calculated, where the payment goes, and then how you can make a difference and take steps to use this to your advantage. So I wish you much luck in paying off your student loans, because I know I'm going to be in this for a few more years. But I hope it helps and that it puts your mind at ease. So thank you for listening. A spreadsheet with all formulas and an explanation of each cell is available for download at www.studioragsart.com.